Want to keep more of the profit from selling your home in your pocket and out of the hands of Uncle Sam? Today we are diving into one of the most powerful and sometimes underutilized or misunderstood tax breaks available to homeowners, the primary residence capital gains exclusion. This is one of the biggest breaks in the tax code when it comes to selling real estate, and it's not talked about enough. In some cases, you can save over 6 figures in capital gains taxes, especially if you've owned your home for a long time. As a starting point, when you sell your home, you might make a profit, which in the tax code, this is called a capital gain. The IRS generally taxes capital gains as they want to share in any profits that you make. But there's a special rule that can help homeowners avoid paying taxes on some or all of that profit when selling what the tax code refers to as your primary residence. If you sell your primary residence for a profit, you can actually exclude up to $250,000 if you file individually, or up to $500,000 if you file a joint return, meaning the gains are completely tax-free. Now, to qualify, you must meet 3 key requirements. Number 1, you have to have owned the home for 2 of the last 5 years. Number 2, you have lived in the home as your primary residence for 2 of those years. And number 3, you have not claimed this primary residence capital gains exclusion in the past 2 years. So let's say, for example, you and your spouse bought a home for $500,000 some years ago, and you sell it today for $1.1 million. That's a $600,000 gain, the difference between what you paid for it and what you sold it for. However, because of this tax break, $500,000 of the $600,000 can be excluded from capital gains tax. This results in a 6-figure capital gains tax savings. Now, here are 2 pro tips from Chris Smith, the CEO of Brandywine Oak Private Tax Advisory, that every homeowner should know before they sell. Number 1, save your original closing documents, especially the HUD-1. Either you or in some cases your realtor should hang on to the HUD-1 settlement sheet from when you bought the home. Why? Because it's loaded with all the key information that helps adjust your cost basis. Your cost basis is simply the total price you paid for the home. So things like legal fees, title insurance, transfer taxes, and other settlement costs are on there. If you don't have the HUD-1, you're likely going to be leaving money on the table. Number 2, and this is a big one, know the difference between repairs and capital improvements. A fresh coat of paint, that's a repair, no tax benefit. A leaking roof that gets fixed, no tax benefit. But a new kitchen, that's a capital improvement that can increase your cost basis and can reduce your taxable gain. Think room additions, decks, garages, major landscaping done or hardscaping, a swimming pool addition, fences, or anything that adds value or extends the life of your home are capital improvements that can add to your basis. The bottom line, keep a folder, either physical or digital, with every upgrade receipt and document from day one. Most sellers in our experience lose out on thousands of dollars because they didn't track what they spent. Don't let that be you. Now, if you've rented the home, use it as a vacation property temporarily, or moved out early, the math gets more nuanced. That's where smart planning really matters. If you're not factoring this into your long-term wealth plan, you could be leaving money on the table. At Brandywine Oak, we help our clients align their real estate decisions with their broader financial and tax strategy. If you're considering a move, downsizing, or selling a property, please reach out. The right timing and structure can make all the difference.